Welcome back to the channel, and a massive hello to everyone tuning in to Gate Gain today. For a deep dive into the world of digital real estate. Today, we are exploring a highly lucrative business model that is transforming how internet entrepreneurs build wealth. E-commerce brand acquisition involves finding online storefronts that are currently struggling, underachieving, or simply mismanaged, and buying them with the intention of breathing new life into their operations. This approach allows you to skip the incredibly painful initial stages of starting a business from absolute scratch, which means you do not have to worry about product testing or building a brand identity from zero. Over the course of this video, we are going to walk you through the exact blueprint required to find these hidden digital gems, negotiate a fair price, optimize their performance, and eventually sell them for a massive payday. Once you identify a potential candidate for acquisition, you must enter the critical phase known as due diligence, which is essentially a deep financial audit. You cannot simply take the seller at their word, which means you need to request direct read-only access to their verified payment processors and dashboards. Compare the revenue numbers showing up in the bank statements with the data on the website backend to ensure everything matches perfectly without any discrepancies. Look closely at the net profit margins rather than just gross revenue. A store making $100,000 but spending $95,000 on ads is not a healthy business. You also need to verify that their traffic is authentic by analyzing web analytics to ensure they are not using artificial methods to boost numbers temporarily. Beyond the financial statements, your due diligence process must thoroughly examine the legal and operational health of the e-commerce storefront. Verify that the business actually owns all the intellectual property it uses, including trademarks, custom website designs, and high-quality product photography. Check if there are any outstanding customer complaints, legal disputes, or negative reviews on major consumer watchdog websites that could damage the brand's reputation. Review existing supplier contracts to ensure manufacturing agreements are fully transferable to a new owner without a massive spike in production costs. Missing a hidden flaw during this phase can turn your dream investment into a financial nightmare, so take your time and review every single detail. After verifying that the business is legitimate, you must transition into the negotiation phase to structure a fair and mutually beneficial acquisition deal. Many beginners focus entirely on the total purchase price, but the actual structure of the deal is often far more important than the final number. You should rarely pay 100% upfront in cash, as this leaves you completely unprotected if hidden problems arise immediately after closing. Instead, aim to structure a deal that includes an upfront cash payment combined with a seller note or a performance-based earn-out spread over months. This means a portion of the price is paid out only if the business maintains profitability, which keeps the seller incentivized to help you succeed. When determining the valuation, the industry standard is typically calculated as a multiple of the seller discretionary earnings over a 12-month period. Smaller, distressed storefronts usually sell for a multiple of between 1.5 to 3 times their annual net profit, depending on stability and growth potential. If a store makes $30,000 in clean profit per year, a reasonable purchase price would fall somewhere between $45,000 and $90,000. You can justify a lower multiple by pointing out weaknesses uncovered during due diligence, such as declining traffic trends or broken supply chains. Always be prepared to walk away from the table if the seller is unrealistic, because the easiest way to lose money is to overpay at the very start. Once the deal is finalized and signed, the transition phase begins, which requires a seamless handoff of all digital assets to ensure the business does not drop. You will need to coordinate the transfer of domain names, website hosting accounts, social media profiles, and email marketing lists into your business entity. It is highly recommended to include a transition support period in your contract, requiring the seller to provide 15 to 30 days of training. This allows you to learn the subtle quirks of the business, understand their current fulfillment workflow, and get introduced directly to their suppliers. A smooth transition ensures that existing customers never notice a change in ownership, preserving the immediate cash flow of the storefront from day one. Now that you are the official owner, it is time to execute the improvement phase, which is where you actually create massive financial leverage. The easiest place to start maximizing your return is by optimizing the existing website user experience to lift the current conversion rate. Many distressed stores have slow loading times or cluttered product pages that scare away potential buyers before they complete their purchase. By compressing heavy images and simplifying the checkout process, you can instantly boost sales without spending more on advertising. If you can raise a website conversion rate from 1% to 2%, you have effectively doubled the revenue of the business overnight. Another massive area of opportunity lies within its existing customer email database. Targets frequently have thousands of past buyers sitting in a neglected list. Implementing automated email flows, such as abandoned cart sequences and welcome series, costs next to nothing but yields incredibly high profit margins. Rekindling the relationship with past customers is significantly cheaper than acquiring new ones, making email marketing a core pillar of your optimization strategy. The third major pillar involves auditing and restructuring the current supply chain to reduce the cost of goods sold and improve shipping speeds. By negotiating directly with manufacturers, you can often cut your product costs by 15 to 30% and improve your margins significantly. Faster shipping times lead to happier customers, which directly translates into better online reviews and a much higher rate of repeat purchases. Once operations are optimized, focus on scaling through diversified marketing channels to avoid vulnerability to single-platform algorithm changes. Collaborate with micro-influencers by sending product samples in exchange for honest video reviews and user-generated content for your store. As the business grows, you must systematically document every process so the business can run completely without you. Hire capable remote freelancers or virtual assistants to handle repetitive tasks based entirely on the written guidelines you have established. After holding the storefront for 12 to 24 months, you reach the final phase, flipping the asset for a significant profit. Ensure your financial records are spotless and time your sale when the business shows a clear upward trend in traffic and profits. The ultimate goal is to sell for a much higher multiple than you paid, walking away with a large cash payout for your next acquisition. Thank you for watching. If you found this guide valuable, please subscribe and give this video a huge thumbs up. See you next time.